Wake up. I want you to pick up your phone, turn off the alarm, and look at the date on your screen. It is Monday morning, February 9th, 2026. If you are looking for logic or reason or the textbook definitions of economics in the markets today, you are not going to find them. You are going to find a crime scene where the laws of gravity have been suspended. You are going to find a battlefield where the rules of finance are being rewritten in real time by algorithms, panic, and sovereign desperation. Take a deep breath, sip your coffee, and look at the scoreboard. Because what you are witnessing right now defies every single model taught in business school. Let's start with the digital king. Bitcoin is trading at $70,542. Yes, you are reading that correctly. Just 4 days ago, on Thursday, February 5th, we watched the sky fall. We watched the government rug pull the strategic reserve narrative. We watched the price spiral vertically down to $60,000 in a liquidation cascade that wiped out billions of dollars of leverage. The media screamed that crypto was dead. The bears were celebrating. And yet, here we are. Bitcoin has risen like a phoenix from the ashes. It hasn't just bounced, it has ripped 15% in a straight line, reclaiming the psychological fortress of $70,000 in a V-shaped recovery that has left bears decapitated and bulls completely confused. This isn't normal market behavior. This is violent. This is a message. Now look at the old guard. Gold has done the unthinkable. For years, analysts told you that $5,000 was the ceiling. They told you it would take a decade to break that level. Well, look at the chart. Gold is trading at $5,022 per ounce. It hasn't just survived the strength of the US dollar, it has humiliated it. The $5,000 barrier has been shattered not by a whisper, but by a sledgehammer of global demand. We are now in pure price discovery mode. There is no resistance above us. There is only the open sky and the realization that the world's faith in fiat currency is evaporating. And then there is silver, the most volatile asset on the planet. On Thursday, it looked like the end of the world for silver bugs. The price crashed from the highs all the way down to a sickening $64. It wiped out every single leveraged long trader. It looked like the industrial economy was collapsing. But look at it this morning. Silver is trading at $81.21. It is up over 4.5% in a single session. It has recovered from the dead. It has shaken off the liquidation event like a bad dream and is charging back towards triple digits. But here's the twist. Here's the part that should make the hair on the back of your neck stand up. Look at the US dollar index, DXY. Usually when assets like gold and Bitcoin are flying, the dollar is crashing. That is the rule. They are on opposite ends of the seesaw. But today, the DXY is sitting at 97.63. It is up. It is flexing its muscles. It is crushing the yen. It is crushing the euro. It is acting like a wrecking ball to the global economy. So we have a situation where the dollar is strong, gold is at an all-time high, and Bitcoin is skyrocketing. Standard economics says this is impossible. This is a three-body problem in finance. It means the correlation is dead. The market has realized that the US dollar isn't money anymore. It is just a measuring stick that is shrinking, even if it looks strong against other failing fiat currencies. We are witnessing a three-way war for the future of value, and investors are voting with their wallets in conflicting, chaotic directions. But the most confusing part, the part that you really need to pay attention to, is the sentiment. I want you to open your sentiment app right now. Look at the Crypto Fear and Greed Index. What does it say? It says 9. 9 out of 100. Extreme fear. Let that sink in for a minute. Bitcoin is trading at $70,500. It is within striking distance of its all-time highs. And the sentiment is a 9? We haven't seen a score of 9 since the FTX collapse in 2022. We haven't seen a 9 since the depths of the bear market when Bitcoin was at $16,000. We are witnessing a historic paradox. Price is at the highs, but fear is at the lows. I am Ben, and today we are going to referee this fight. We are going to dig deeper than anyone else into this anomaly. We are going to find out who wins in 2026. Is it the coercive power of the US dollar, backed by the US military and the Federal Reserve? Is it the eternal stability of gold and silver, backed by 5,000 years of history? Or is it the asymmetric upside of Bitcoin, backed by mathematics and code? Let's analyze fighter number 1, the US dollar. Why is the DXY at 97.63? Why is the dollar strong if the US debt is spiraling to $36 trillion? Why is it strong if inflation is eating your paycheck? It is not because the US economy is healthy, it is because of fear. Over the weekend, while you were worrying about your crypto portfolio, something broke in the stock market. US tech stocks, the darlings of the AI bubble, the Nvidias, the Microsofts, started to crack. Investors got spooked by the insane valuations. They got spooked by the regulatory threats coming from Washington regarding AI safety. So they sold stocks. And when a traditional investor sells a stock, where do they go? They don't go to Bitcoin. They go to cash. They go to the US dollar. That selling pressure in the stock market created a temporary, massive demand for dollars. That is why the DXY is up. It is a flight to safety. The dollar is winning the battle against the euro and the yen, which are collapsing under their own debt loads. But the dollar has a weakness. It is living on borrowed time. With interest rates at 3.75%, the US government is paying over $1 trillion a year in interest. They are borrowing money just to pay the interest on the money they already borrowed. This is a Ponzi scheme. A strong dollar bankrupts the American state. So while the dollar looks strong today at 97.6, it is like a bodybuilder on steroids who is about to have a heart attack. Now look at fighter number 2. Gold and silver, the metals. Gold crossing $5,000 is the loudest signal in the world. It is not reacting to the dollar anymore. It is ignoring the DXY. It is reacting to the geopolitics. Central banks in China, Russia, India, Poland, and Singapore saw the tech wobble over the weekend, and they didn't buy dollars. They didn't trust the US Treasury, they bought gold. They are draining the vaults of London and New York. This is the great decoupling. Gold is saying that it doesn't care about the 3.75% interest rate. It cares about solvency. It cares about counterparty risk. And silver is the wild card. It crashed to $64 last week in a liquidation panic and has snapped back to $81.21. Why? Because silver is betting that the dollar will break. Silver is the high beta version of gold. If the dollar cracks, silver is the asset that will run the fastest. The metals are winning the battle for trust. They are the only assets with zero counterparty risk in a world where every counterparty is broke. And finally, fighter number 3, Bitcoin. Why did it bounce from $60,000 to $70,542 in the face of a strong dollar and a rug pull news cycle? Because $60,000 was the line in the sand. When the price hit $60,000 on Thursday, the sellers ran out of ammo. Everyone who wanted to sell, the panicked retail traders, the over-leveraged gamblers, the people who believed the strategic reserve hype and got rug pulled, had already sold. Who was left to buy? Institutions, BlackRock, Fidelity, the sovereign wealth funds. They realized that Bitcoin is the only asset that can act like a tech stock and a store of value at the same time. They are using Bitcoin to front-run the inevitable money printing that will save the dollar from its heart attack. Bitcoin is winning the battle for growth. It is the fastest horse in the race. So, here's the setup. We have a three-way standoff. The dollar is holding a gun to the head of the global economy with high rates. Gold is building a fortress to protect wealth from the fallout. And Bitcoin is building a rocket ship to escape the system entirely. The problem for you, the investor, is that you cannot be all in on everything. If the dollar keeps rising to 100, it will crush Bitcoin and silver in the short term. If the dollar collapses tomorrow, holding cash is suicide. You have to pick your fighter, but you have to pick carefully. The fear index of 9 suggests that the crowd is betting on the dollar. They are scared. They are sitting in cash. And usually the crowd is wrong. The crowd selling their assets to hold dollars at the exact moment gold hits $5,000 is a sign of capitulation. This is what we call the wall of worry. Markets climb a wall of worry. Right now, the wall is vertical. Everyone is worried about the dollar. Everyone is worried about the tech crash. Everyone is worried about the regulations. And while they worry, the prices of hard assets are drifting higher, leaving the doubters behind. In the next part of this massive deep dive, we are going to look at the specific performance of silver and gold versus Bitcoin in a recession scenario. We are going to ask the hard question: if the US economy enters a recession in 2026, which of these two assets survives? Does Bitcoin crash like a tech stock, or does it fly like gold? And is silver the bargain of the century at $81, or is it a value trap waiting to go lower? We are going to break down the risk-to-reward ratio for the next 6 months in agonizing detail. Now that we have introduced the fighters, let's get into the ring and analyze the matchup in agonizing detail. We have the US dollar trying to suffocate the world with high interest rates. We have gold and silver trying to protect purchasing power against a sovereign default. And we have Bitcoin trying to escape the matrix entirely. The question is, in the specific economic environment of 2026, which one of these assets is telling the truth? Because right now, they are all screaming different things, and usually when markets diverge this violently, something breaks. Let's look at the gold and silver alliance first. Gold trading at $5,022 is the most bearish signal for the American empire that has ever existed. You have to understand that gold is the anti-dollar. When gold hits an all-time high while the dollar is also strong at 97.63, it means one thing. It means the market believes the US government is fundamentally insolvent. It means that foreign nations are willing to pay a massive premium to exit the dollar system immediately. They are not waiting for the dip. They are market buying. Gold is not a trade right now. It is a lifeboat. And silver trading at $81.21 is the sleeper agent. Remember, silver is a schizophrenic asset. It is half money, half industrial commodity. The fact that it bounced so violently from the 64 liquidation lows suggests that the monetary panic is overtaking the industrial recession fear. People are terrified of their bank accounts freezing. They are terrified of CBDCs. They are buying silver junk coins and bars because they want something tangible that they can hold in their hand. If you hold metals, you are betting against the system. You are betting that the $36 trillion debt pile will collapse the bond market, forcing the Fed to print trillions to monetize the debt. And history is on your side. Every fiat currency eventually goes to zero against gold. It is not a matter of if, but when. Now, let's look at Bitcoin, the digital predator, trading at $70,542. Bitcoin is in a weird spot. It is acting like a hybrid. On one hand, it moves with the Nasdaq. When tech stocks dump due to AI regulation fears, Bitcoin dumps. That makes it vulnerable to a recession. If the US enters a hard landing in 2026 and corporate earnings collapse, Bitcoin could flush again because it is treated as a risk asset by Wall Street algorithms. But on the other hand, Bitcoin held $60,000 like a rock. It refused to die. This suggests it is transitioning. It is becoming digital gold. The institutions are using it as a hedge against the banking system, just like gold. But here is the risk. Bitcoin is leverage sensitive. Unlike gold, which sits in a vault, Bitcoin is traded with massive leverage on offshore exchanges. If the $DXY spikes to 100, it creates a margin call cascade. Bitcoin could drop 20% in a day, while gold might only drop 2%. Bitcoin is the Ferrari. It is fast, it is sexy, but if you hit a pothole, you die. Gold is the tank. It is slow, but it crushes everything in its path. And then there is the villain of our story, the US dollar. Why is it still fighting? Why hasn't it collapsed yet? Because of the dollar milkshake theory. The US has the highest interest rates in the developed world at 3.75%. Europe is at 2%. Japan is at 0%. Capital flows to where it gets treated best. So money is flooding into the dollar to get that yield. This sucks liquidity out of the rest of the world. It hurts emerging markets. It hurts crypto. It hurts everything priced in dollars. The DXY at 97.6 is a wrecking ball. It is trying to destroy the other two fighters. But the dollar has a fatal wound. The interest payments on the US debt are now higher than the defense budget. They are borrowing money just to pay the interest on the money they already borrowed. This is a debt spiral. The dollar is strong today, but it is terminally ill. The moment the Fed pivots, the moment they cut rates to save the government from bankruptcy, the dollar will drop like a stone. And that is when the other two fighters win. So who wins the next 6 months? If we get a deflationary crash, a recession where people lose jobs and sell assets to pay bills, the dollar wins temporarily. Cash is king in a crash. Bitcoin would likely drop to $50,000 or lower. Silver would get crushed back to $60. Gold would hold up best but still dip. However, if we get an inflationary response where the Fed prints money to stop the crash, then the dollar dies immediately. Bitcoin goes to $150,000, gold goes to $6,000. Silver goes to $150. The market right now, with Bitcoin at $70,000 and gold at $5,000, is betting on the second outcome. The market is betting that the Fed will capitulate. They are betting that the dollar is bluffing. We also need to talk about the psychological warfare being waged on you. The reason silver dropped to $64 on Thursday wasn't just economics. It was a targeted attack on your will to hold. The institutions know that retail investors love silver. By crashing the price 30%, they triggered a wave of despair. They wanted you to sell your physical stack. They wanted you to give up. And then when you sold, they bought it back and pumped it to $81. This is the game. They play with your emotions. They use volatility to steal your position. If you own silver, you have to be willing to see it drop 50% and not blink. You have to understand the math. The gold to silver ratio at these prices is screaming that silver is undervalued. If gold is $5,000 and the historical ratio is roughly 15 to 1 or 20 to 1, silver should be over $200. The fact that it is $81 represents a massive inefficiency. It represents a coiled spring. But springs snap back violently. If you are leveraged on silver, you will get wiped out before the payday. If you hold physical, you just have to wait. In the final part of this deep dive, we are going to build your battle plan. We are going to construct the unbreakable portfolio using the barbell strategy. We are going to discuss exactly how much cash you need to survive the short-term dollar wrecking ball and how much Bitcoin and gold you need to capture the long-term wealth transfer. We will give you the specific buy zones for silver and Bitcoin so you don't chase the pump. We have analyzed the fighters. We know the dollar is a dying giant still throwing punches. We know gold is the shield and Bitcoin is the sword. Now, how do you position yourself to survive the chaos of 2026 and come out wealthy on the other side? You don't guess, you don't gamble. You use the barbell strategy. This is the only way to win a three-way war where the outcome is uncertain in the short term but guaranteed in the long term. Imagine a barbell with weights on two ends. On one end, you hold cash. Yes, I know I just told you the dollar is dying, but right now, with the DXY at 97.63, cash is your ammunition. While everyone else is fully invested and sweating every tick of the chart, you hold 20% to 30% of your net worth in boring, unsexy US dollars or short-term treasuries, earning that 3.75% yield. This cash allows you to sleep at night. It allows you to be the vulture. When Bitcoin crashed to $60,000 last week, the people with cash were kings. They bought the blood. The people with zero cash were victims. They panic sold. Don't be a victim. Rebuild your cash pile. This protects you if the dollar wrecking ball swings one last time and crashes the markets into a deflationary spiral. On the other end of the barbell, you hold your hard assets. You hold Bitcoin, gold, and silver. You don't sell your core position, you hold it. Because eventually, maybe next week, maybe next month, the US debt math will break the dollar. Mathematically, the dollar must go to zero against hard assets over time because the debt is compounding faster than the economy can grow. So you hold your Bitcoin for the asymmetric upside, you hold your gold for the wealth preservation, and you hold your silver for the explosive leverage play. But here's the key to the strategy. You do not chase green candles. Buying Bitcoin here at $70,542 after a vertical rally from $60,000 is risky. You are buying the hope. Let the market come to you. If Bitcoin dips to $65,000, you deploy some of your cash. If silver stays at $81, you accumulate slowly. You act like a mercenary. You have no loyalty to any asset class. You only have loyalty to value. Here is your action plan for February 2026. First, watch the DXY. Make this your home screen. If DXY goes above 98, do not buy crypto. The pressure is too high. The wrecking ball is swinging. If DXY breaks below 96, that is your signal. The Fed is losing control. That is when you deploy heavy capital into gold and silver. Second, the sleep test. Look at your portfolio today. If Bitcoin drops back to $60,000 tomorrow, will you panic sell again? If the answer is yes, you have too much exposure. Sell some now at $70,000. Take the gift the market gave you. Rebalance into cash. You need to survive the shakeout to enjoy the payout. Third, the automated buy. Set up a recurring buy for Bitcoin and gold. Stop trying to time the market. The fear index is 9. That means the bottom is likely in, but the volatility is not over. Dollar cost averaging removes your emotions from the fight and ensures you catch the average price over time. We also need to address the ultimate goal here. Why are we suffering through this volatility? Why are we analyzing the DXY and stress testing our portfolios? It is not to buy a Lamborghini. It is not to flex on Instagram. The point of money is freedom. Freedom from the alarm clock that woke you up this morning. Freedom from the boss who doesn't respect you. Freedom from the anxiety that sits on your chest when you read the news about a recession. When you have debt, you are a slave to the past. When you have no savings, you are a slave to the present. But when you have wealth, when you have the FU fund and the hard assets, you own the future. You are doing this so that when the Federal Reserve decides to print another $1 trillion, it doesn't destroy you, it inflates your assets. You are doing this so that when the government rug pulls a promise, it doesn't ruin your life, it barely inconveniences you. You are doing this to become the central bank of your own life, to be sovereign, to be unbreakable. The market crash of February 5th was a test. The recovery of February 9th is the result. You have survived the whipsaw. You have seen $60,000 and you have seen $70,000 in the span of a long weekend. You are battle-tested now. Do not let the volatility shake you out. The everything crash was just the system clearing its throat before the real message is delivered. And the message is, the dollar is dying and the world is moving to hard assets. You are early. You are right. You just have to be patient. I am Ben. The dollar is fighting for its life, but we are playing for our freedom. Stop complicating it. Start getting free.